It is 9:15 a.m. Pacific Daylight Time. It is the 8th day of May 2026, and this is episode 1317 of Bitcoin, and with me, your host, David Bennett, bringing you news about Bitcoin and macro from around the world. And we're going to start in Europe. Little Fifi Lagarde seems to be very terrified of stablecoins because she's delivering yet one more warning about how it could cause financial stability risks, and we'll get to that. That's going to be the first thing up today. Then the IMF is warning about AI. So between Fifi Lagarde's two institutions that she's been chief of, both of them are freaking terrified of stuff. But we're not done with AI yet, because then we're going to talk about AI's use in cryptocurrency payments and whether or not that will make users end up using cryptocurrency more, simply not because they're using it themselves, but because they're using agents, and agents start opting to use Bitcoin. We'll see. It'll be interesting to find out. Block Inc., Jack Dorsey's outfit, they raised their guidance after a solid Q1, so their earnings came in, and numbers came in. The jobs report is in, and we're going to do that when we do the market stuff. Then in the second part, Antpool, Block, Foundry, Spiderpool, Mara, Foundation, and Demand are all joining a working group, and it's a working group that was constructed by somebody that we all know and love. And then, if maybe not, it depends on if I can get this thing. Canvas. Now, this is a departure from Bitcoin, but if you don't know what Canvas is, it probably means that you're not in K through 12 or in a college or a university. Canvas is used by those institutions religiously, and they just got their asses handed to them because of it. GameStop, they're hitting a credit wall on this bid for eBay. And speaking of eBay, why don't they should probably just ignore the whole GameStop play to buying them altogether and just use Bitcoin. And then at the very end, we'll be back in Europe, where hyper concentration of crypto wrench attacks hit a high in the first quarter of this year. So it's getting worse for people that hold Bitcoin in Europe. Be very careful out there. Let's go to the ECB, the European Central Bank, and talk to Fifi Lagarde as she flags euro-denominated stablecoins as a financial stability risk, diverging from what the Bundesbank stance is. And this is the block written by Naga Avan Namoyo. ECB President Christine Lagarde on Friday made one of her most direct cases yet against euro-denominated stablecoin, arguing the risks to financial stability and monetary policy transmission outweigh any benefit to the euro's global standing. Speaking at Banco de España LATAM Economic Forum in Spain, Lagarde pushed back against the view that Europe needs its own stablecoin ecosystem. A position Bundesbank President Joachim Nagel publicly backed back in February. Quote, "The case for promoting euro-denominated stablecoin is far weaker than it appears," Lagarde said. Now, the core of her argument was the separation between what she called the monetary function of stablecoins, extending reserve currency reach, and their technological function, which she said can be served through public infrastructure anchored in central bank money. Europe's task, she argued, is not simply to replicate instruments developed elsewhere. The specific trade-offs she cited include bank runs and depegging events of the kind that rippled through the markets during the 2023 SVB Circle episode, deposit substitution that narrows the bank lending channel in Europe's bank-dependent financial system, and even broader fragmentation risk. She also referenced an ECB working paper from March that warned widespread stablecoin adoption would pose major risks to euro area banks and the institution's monetary sovereignty, particularly when linked to foreign currency. Lagarde pointed instead to the ECB's own tokenized wholesale settlements projects, Pontus and Appia, as the appropriate infrastructure for Europe's digital finance ambitions, alongside deeper capital market integration through the Savings and Investment Union. The speech pretty much extends a consistent pattern from the president of the European Central Bank. Back in September of 2025, Lagarde urged stricter oversight on non-EU stablecoin issuers at a conference, calling for tighter MiCAR enforcement to prevent foreign issuers from exposing EU reserves to runs. Her warnings on stablecoins also stretch back to at least 2023, when she argued they posed greater privacy risks than a digital euro. Friday's speech sharpened that long-running skepticism into a direct challenge to the euro stablecoin case specifically. The escalation in Lagarde's rhetoric is notable given the growing momentum among European banks and payment firms toward rolling out their own products under MiCAR. A consortium of 12 major European lenders is already moving to compete in that space. Operating under a Netherlands-based joint venture called Kivalis, the group is targeting a commercial launch of a MiCA-regulated, euro-denominated stablecoin for the second half of this year. The debate plays out against a lopsided market, however. USD-backed stablecoins account for the overwhelming majority of total stablecoin supply, while non-dollar denominated tokens represent but a fraction of a market, according to the block's data dashboard. So Lagarde is escalating her rhetoric about please do not use a stablecoin representing the euro that is not controlled by the European Central Bank, which means that all European banks would basically have to do what Fifi Lagarde says. And what she's seeing is that all these lenders and a whole bunch of banks, including Bundesbank, one of the largest European banks that there is, they all want to not do what she's saying. She's losing control. The European Central Bank is starting to fracture. It's starting to fragment, and Lagarde she is beside herself. So now she's cranking up the fear talk about how stablecoins are going to destabilize everything. And yeah, for her, it absolutely is. And for Europe as the greater European Union, yes, there is a huge problem with all these banks going, well, we can just do our own product. We can do our own stablecoin. Eventually, what will happen is the European Union will break up. And that would have happened with or without stablecoin. The European Union is toast. It's already dead. It just doesn't know it yet. You know, it's one of those things where it's like what that movie with Bruce Willis and that kid, you know, I see dead people. He doesn't know he's dead until the very end of the movie. That's sort of like what European Union is walking around. And I know there's a lot of people that are big fans of the European Union, but it didn't work. And there was no way that it was going to work. You can't stitch together that many different cultures. And yes, even though it's all Europe, there's a lot of representative singular cultures. The Spanish are not the French. The French are not Britain, right? The Netherlands don't have shit to do with the culture of Portugal. And you tried to stitch them all together in this quilt and hold them that way through basically economic sanctions. And Lagarde sees all of the threading of that quilt just starting to fray. Well, there's another institution that's warning about stuff, and that's the International Monetary Fund. They're warning AI will supercharge cyber attacks on global financial system. Yeah, you knew that was coming. Andrew Hayward from decrypt.co. The International Monetary Fund warned on Thursday that AI is rapidly amplifying the threat of cyber attacks against the global financial system, potentially turning localized breaches into economy-rattling shocks that could shake markets, freeze payments, and erode confidence in banks worldwide. In a new blog post, IMF economists pointed to the controlled release by Anthropic of the advanced AI model Claude Mythos preview as a stark illustration of the accelerating threat. The model was found capable of identifying and exploiting vulnerabilities across every major operating system and every major web browser, even in the hands of non-experts. The findings underscore a troubling new reality for financial regulators. The barrier to launching a sophisticated cyber attack is falling fast. Quote, this foreshadows how fast-moving AI-driven cyber risks could destabilize the financial system if not managed carefully. Using it for the management play. And it's also why authorities must focus on building resilience through supervision and coordination rather than treating these developments as just purely technical or operational issues, the IMF wrote. They caution that AI may further concentrate risk across the financial system with a single exploited weakness capable of rippling across many institutions simultaneously. Heavy reliance on a small number of cloud providers, software platforms, and AI models means one successful attack could trigger cascade failures. The fund said such scenarios could elevate cyber incidents from operational headaches to what it described as potential macro financial shocks, setting off confidence risks, liquidity strains, and fire sale dynamics across all markets. Yet, the IMF was careful to note that AI is also part of the solution. As attackers increasingly operate at machine speed, financial institutions are deploying AI. Oh my God, what happened? Hold on for a second. For some reason, my other browser just decided to pop up and say hello, covering the story. Let's try it again. As attackers increasingly operate at machine speed, financial institutions are deploying AI-assisted tools of their own to detect threats and prevent fraud and accelerate incident response. The geopolitical dimension of the threat loomed large in the fund's analysis. Cyber risk does not respect national borders, and inconsistent oversight across countries could weaken the globally interconnected financial system. Emerging economies, often constrained by limited resources, may face disproportionate exposure. The IMF urged policymakers to treat cybersecurity not as a technical or operational matter, but as a core financial stability concern, prioritizing resilient standards, systemic supervision, and international coordination to contain breaches before they spread. Users on Myriad, a prediction market operated by Decrypt's parent company, Dastan, didn't expect Anthropic to be publicly released or to publicly release the powerful Claude Mythos model by June the 30th, penciling in a 17.5% chance as of this writing. So, this is getting hot because now they realize that it's not going to be just DeFi and small projects that get hacked and turned into the gigantic piles of shit that they always were. And I'm speaking specifically of the whole DeFi ecosystem. No, it's going to come after all of the exchanges, all of the banks, all of the central banks, all of the rails that interconnect these banks, like Swift. It's all fair game. And guess what? 90% of all the banks in the world still run COBOL. It's a programming language. I think it was probably written in the 50s. And generally speaking, all the banks that a lot of the banks out there are still using COBOL. And it's almost impossible to find anybody who actually knows how to work with the COBOL programming language. These guys are in real fucking trouble. And I am absolutely shocked that something major hasn't happened to them already. But they're right. You know, as pressures increase externally, internal pressures are going to push back against that. It's the system will always equalize itself. It's always been that way. It's always going to be that way because that's sort of a law of the universe. Nature abhors a vacuum. It doesn't necessarily even like low pressure systems. Eventually, those pressures will equalize. So, I mean, I'm not worried, but I'm just saying this kind of thing could cause something like Bitcoin to really, really start taking hold by banks themselves, by institutions themselves, and retail. We've got lots of reports of what they are calling light retail activity in Bitcoin, and that may change. I mean, like you get a straight up freaking hack on the whole of Wells Fargo. And all of a sudden, people, a lot of those customers may start looking at something like Bitcoin going, this is the only thing that actually hasn't been hacked. Can Bitcoin wallets get hacked? Yeah, hot wallets. If you're keeping your Bitcoin on a cold wallet, I really wouldn't worry about it. Is there any other entry point into the Bitcoin system from the time you make a transaction to the time that it's actually confirmed inside of a block? Yeah, there's a couple of places that are still kind of external that can still be kind of, the feathers can get ruffled. But by and large, not like the banks, not like these institutions, and they're next. And the IMF is absolutely correct to actually be calling the alarm right here. And I'm surprised that they didn't call it out sooner. But, maybe they were like, oh God, we can't even talk about this. It's going to freak people out. Well, now it's so bad that they're actually saying, screw it, freak the people out. Now, speaking of people using crypto because of possibility of AI hacking on global financial networks and systems, artificial intelligent agents could solve crypto's user problem, according to CoinDesk's Sam Reynolds. And he says that the crypto industry's embrace of AI is less about chatbots and more about building financial infrastructure for autonomous machines, says Chappie Asel. What a great name. A former Apple engineer and founder of AI nonprofit, the AI Collective. Speaking at Consensus Miami, Asel, founder of the AI Collective, a global nonprofit AI community with more than 200,000 members across 150 plus chapters, argued that as software agents increasingly make economic decisions on behalf of users and businesses, they're going to require payment systems capable of handling low latency, programmable transactions at scale. Quote, when agents make the majority of financial decisions, economic decisions, how do they transact with each other? You want them to be highly systematic, mechanistic. You want very small microtransactions. You want very low latency, Asel said during the panel. Asel, who previously worked on Apple's Vision Pro and early Apple intelligence efforts before launching the AI Collective, framed the convergence of crypto and AI through a practical lens. Quote, the number one thing that I've heard kind of throughout this conference, even my friends who only know about AI, they know nothing about blockchain, is that they've heard about agentic payments, he said. Stablecoin already offer 24/7 settlement, and smart contracts allow programmable execution. Marrying them together is the only logical way agentic payments without a human in the middle can become mainstream. Still, the thesis remains early. AI agents are still nascent, and many companies today rely on centralized APIs and conventional payment systems. Attempts to build agentic payments infrastructure have so far generated little meaningful commercial activity, suggesting the narrative may be developing faster than actual demand. Even if machine-to-machine commerce takes longer to materialize, Asel argued the broader overlap between crypto and AI may emerge elsewhere first. Quote, a lot of people will tell you, oh, it's the models aren't good enough. It's none of that. It's literally compute, data centers, energy that is driving pretty much all decision-making in AI right now, Asel said. That framing reflects a wider shift in the AI economy where access to chips, power, Data center capacity is becoming the defining competitive advantage. Parts of the crypto industry are already moving to capture that opportunity. Several Bitcoin miners have spent the past year repositioning toward AI hosting and high performance compute, betting that infrastructure originally built for mining can be repurposed for AI workloads. For ASOL, the practical advice for founders navigating the uncertainty was simple: experiment. Quote, when the world is more uncertain than it ever has been, things will only get crazier. That warrants that you are spending more and more time playing around with the new technology, he said. Crypto's consumer adoption problem has always been partly a usability problem. But AI agents do not need onboarding tutorials. They aren't intimidated by MetaMask or need help remembering seed phrases. If autonomous software becomes a meaningful economic actor, crypto may have found a user base that actually thinks in code. That's a really good article. I really like the way that this is worded, especially this thing at the end, where, you know, before, for me to use, I don't know, like some kind of like Sparrow wallet or something like that, I may have opted to go and look for a YouTube tutorial from, like, I don't know, Ben, one of the Bens, and I can't remember his name right now. But, you know, and you take a, like, you know, what I'm trying to say, an hour-long tutorial on how to effectively use Sparrow Wallet. Dude, an AI agent can just crawl the GitHub repository for Sparrow Wallet, read everything, and understand exactly how to use it inside of like 10, 15 seconds. Now, this is both bad and good, because as a user who opts to allow my AI agent to know how to use Sparrow Wallet so that I don't have to, I'm ceding a lot of control to the AI agent. And guess what? This is going to happen. And it's going to happen at scale. And I don't like the idea, but I'm not going to be able to stop it, and neither are you. This is the way people are built. I kind of believe that there's two guiding lights for most of humanity. One is greed, and the other one is being fucking lazy. I'm just saying. And the combination of the two, oh boy, that's where we have the whole get rich quick scheme stuff come from. And that's the birthplace of get rich quick. I don't want to do any work, and I'm greedy. Do the math, man. This is probably not going to end well for quite a few people, especially in the early stages. But be that as it may, I captured something at the top here of this article. Let me reread this quote. When agents make the majority of financial and economic decisions, how do they transact with each other? And it's not the second part of the sentence, it's that first part. When agents make the majority of financial decisions and economic decisions, we're going by and large, at scale, a great big old number of average worldwide citizens are going to allow AI agents to make financial decisions and economic decisions. Some just for shopping. Some how to regulate and make sure that my retirement account is solid. One, if I send an agent to Walmart and it buys the wrong thing, not so bad. My retirement account, dude, are you shitting me? But it's going to happen. Just sit back and watch it happen. And while you're watching it happen, just make sure that you've been buying Bitcoin and that you hold your Bitcoin. That's all you have to do. Because between the IMF pulling the alarm cord on, oh my God, the global economic system is completely unguarded with this whole AI thing going on, and we've already seen what it can do to DeFi, right? And we're going to get to the Canvas story in the back half of the show, right? Between that and laziness and greed, this is good. This is what a time to be alive. That's what I'm trying to say. What a time to be alive. But don't get caught with your britches down. Just buy Bitcoin and hold Bitcoin. Block Incorporated. Guidance raised after solid Q1 $173 million Bitcoin loss. It's good and bad news from Atlas 21. Block Incorporated, the fintech company founded by Jack Dorsey, has released its first quarter 2026 results, reporting a Bitcoin revaluation loss of $173 million tied to the fair value accounting of its BTC reserves. The loss contributed to an overall net loss attributable to common shareholders of $309 million for the quarter. But despite this, the company raised its full-year guidance, citing solid operational execution. The Bitcoin loss is non-cash and unrealized in nature, reflecting the fair value measurement of the company's Bitcoin treasury and customer reserves. In total, Block holds 28,355 Bitcoin worth about $2.2 billion. The adoption of fair value accounting standards exposes the balance sheets of companies with Bitcoin treasuries to quarterly fluctuations, as already seen in the case of Strategy and other players in the sector. But on the operational front, Block's total gross profit grew 27% year over year to $2.9 billion. Cash App, the group's primary consumer app and one of the leading retail Bitcoin purchase channels, recorded gross profit growth of 38% to $1.91 billion, driven by lending and banking and commerce. However, Bitcoin's contribution to Cash App was down 31% year over year, while Square recorded no significant movement in its own segment. Bitcoin-related revenues across the entire group reached approximately $28 million, largely offset by related costs, with the impact on gross profit described as negligible. On an adjusted basis, operating income increased 56% to $728 million, bringing margins to a record level of 25% of gross profit. Adjusted earnings per share grew 52% to 85 cents a share. In the earnings release, Block stated, quote, "We are raising our annual guidance to reflect our strong execution and increased expectations for the remainder of the year, pointing to gross profit growth of 19% for 2026 and adjusted diluted earnings per share growth of 62%. The corporate context is relevant. In February 2026, during the previous earnings call, Block had announced a 40% reduction in its workforce. Since then, the XYZ stock, Block's ticker symbol, has gained approximately 25%. All right, so there's three things working all together here. There's general operational kick-assness going on, but we can't tell if that's just straight up more business coming in or the fact that they have reduced their workforce by 40% in February of 2026. The third thing that's going on here stands alone, and that's the revaluation of Bitcoin that sits on these companies' balance sheet. And because of the October 10th crash and subsequent bear market that's come out of that, you got Block kind of reflecting that in some ways it doesn't look so good, right? But operationally, Block and Square and Cash App, they're all looking pretty freaking tight. So it's interesting to see Jack Dorsey raise guidance on Block as a whole, given that they're taking it in the balls on revaluation of Bitcoin. But I think they can use that as for their taxes. I'm not sure. It'll be interesting to see exactly what they can do with having their Bitcoin revalued at fair market value, and see if they can get anything good out of that. Who knows? Let's run the numbers. The U.S. labor market continued to show at least modest strength in April, according to data released this morning by the Bureau of Labor Statistics. So here's the jobs numbers. The economy added 115,000 jobs during the month. It's well above the economist's expectations for a mere 62,000, though it is down from the 185,000 in March and that was revised from an originally reported 178,000. So they revised that thing up. There's also another number. Hold on for a second. I gotta get this one for you. If I can find it again, because the Michigan sentiment report came in, and let's see. I cannot find it again, but the number was lower in the Michigan consumer index or consumer confidence report than the economist expected. So there's two things that are working on the markets at least in the United States, but that always has global implications. One, we almost doubled the amount of jobs, non-farm payroll jobs, that the economists were expecting, and consumer sentiment is still down. Now, in my opinion, both of those are kind of working together to possibly get the Federal Reserve to consider lowering interest rates. And if the money gets cheaper to borrow, the chances that things that are considered risk assets, of which Bitcoin is still considered one, their prices start to actually go up because people borrow this cheaper money. They figure that they're going to make enough money to pay off the ability to pay back the loan or the interest on the loan while they're holding it, because it's essentially what's going on. And people start piling into risk assets like precious metals, equities, Bitcoin, things of that nature. But the markets aren't really reflecting that. See, that's what's going on here is that I think if everybody is just freaking confused as shit. Right now, let's start with energy. Everything is in the green, so I guess the new Iran-U.S. peace deal is already on the ropes. Brent North Sea is up 1.5 to 101.48 cents. West Texas Intermediate is up over 1 point to 95.87. Natural gas is up 0.5 to $2.78 per thousand. Gasoline is up 1 point to $3.49 per gallon, and Merbon crude 2.7% in the green to 99.35. Metals are mixed, with palladium down 2 1/3, but gold is up 1/3 to 47.26 2 dimes. Platinum is down 1/4. Silver is up almost a full point to $80.95, and copper is up 2 points. Ag is mostly in the green. Chocolate losing some of its edge today, down 3.6%. Biggest winner today is and the winner is cotton, 1.6% to the upside. Live cattle down barely anything at all. It's in the red. It's like 0.05. Lean hogs down 0.6, and feeder cattle down 0.6 as well. Now, the S&P is up 0.75%, and the NASDAQ is screaming 1.88% to the upside, but the Dow is unchanged. The S&P Mini is up 0.47%. Now, the NASDAQ and the S&P, those guys are up because the tech bros, their quarterly reports have been coming in, and most of them look really, really good. Really good. And right now, the S&P and the NASDAQ are at all-time highs. But the Dow is at 49,688, which is kind of well off of its all-time high that was done yesterday or the day before, and I think it was like 50,515. So it's kind of just chilling out there. But then there's Bitcoin, which I expected to have a better response to higher jobs and crappy sentiment. $79,780 per coin. That's a $1.6 trillion market cap. And we can get 17 ounces of our favorite shiny metal rock with our one Bitcoin, of which there are 26,288.65 of. Average fees per block are normal. There's about 35 blocks carrying 48,000 unconfirmed transactions waiting to clear at high priority rates of 1 sat per VByte. Low priority gets you in at 0.3. 970 exahashes per second is the hash rate right now on the Bitcoin network. So a steady increase from yesterday and the day before and the day before that. From Clarity by July, yesterday's episode of Bitcoin and Nick Dose with 208 sats says cheers. Noster Gang with a small row of sticks says thank you, no thank you, sir. And I remind you, donations and streaming me sats through something like any kind of podcasting 2.0. It can't be a legacy podcast app like Apple Podcasts because they don't have all the full functionality that podcasting 2.0 apps have. Like I use Fountain app as my daily driver. Love that thing. And it gives me all the ability to stream Satoshis to my favorite content creators while I'm listening to their podcast. I can boost their show with Satoshis. I can leave them a message with Satoshis. I can do all this stuff. And I like this last week, man, has been a really down week on numbers all across the board. Not only listeners, but also people that are like, streaming me Satoshis and sending me boosts with things for me to read. So please support the Bitcoin podcaster, because we are the only people that truly know how to have fun staying poor, and that's the Weather Report. Welcome to part 2 of the news that you can use. Ant Pool, Block Incorporated, F2 Pool, Foundry, Spider Pool, Mara Foundation, and Demand joined Stratum V2 working group. Bitcoin Magazine. It's written by Shinobi. The Stratum V2 working group announced today that Ant Pool, Block, F2 Pool, Foundry, Spider Pool, Mara Foundation, and Demand have joined the working group to advance the adoption of the Stratum V2 protocol. The working group was founded in 2022 by Brains and Spiral to develop and maintain the Stratum V2 protocol as an open and vendor-neutral specification usable by the Bitcoin mining ecosystem. The protocol is an upgrade to the original Stratum mining protocol, bringing massive efficiency gains, privacy, security, and functionality that can be used to improve overall mining decentralization. The onboarding of the new members, all substantial players in the mining ecosystem, represents a big leap forward for the working group's progress in ensuring proper functioning and compatibility across real-world mining operations at scale. It also shows a growing consensus in the mining ecosystem that Stratum V2 is the direction to take into the future. Quote, "We're proud to support the broader adoption of Stratum V2. Aligning around an open, interoperable standard enables the industry to collaborate more effectively and drive improvements in efficiency, security, and decentralization," said Andy Zhao, CEO of Ant Pool. Stratum V2 supports mechanisms for more efficient management of large fleets of miners. It's end-to-end encrypted and allows individual miners to produce their own block templates with supporting pools. Kenwei Wang, CTO of Spider Pool, had this to say, quote, "Decentralization is core to our mission. Stratum V2 supports this by enabling miner-constructed templates while also improving efficiency, especially for miners in bandwidth-constrained environments. The Stratum V2 working group is an open collaboration initiative dedicated to advancing the development, adoption, and interoperability of the Stratum V2 mining protocol." Okay, this is really good because Ant Pool, Block, F2 Pool, Foundry, Spider Pool, Mara, and Demand, that's a lot. That's a big names. Big names in mining. But I got another fish dying to be fried, and it's right here. New York Times, Canvas online learning platform shut down for hours after a cyber attack. Okay, let me preface this as to why we're talking about Canvas. It's not a shitcoin. It's not a DeFi protocol. It has nothing at all to do with Bitcoin or the wider cryptocurrency ecosystem. It is a system that has been adopted widely by universities, colleges, both large and small. Community colleges use this thing. K through 12 public schools use this thing. And you ask, what does Canvas do? Well, it does everything. It's sick. This is a centralization nightmare when it comes to education. How do I know? Because I worked for years at an educational institution and my wife still works for one and has to use Canvas, and her Canvas is down. So what does it do? Okay, first, most teachers are required, at professors especially at the college level, most professors at schools that have opted to use Canvas are required to put all of their class materials onto Canvas for that class, and the only people that have access to that particular Canvas page would be the students and the professor, and of course like the provost and president and any of the higher ups of the university. But like if I'm in a math class, I can't access some English classes Canvas. I can access my own math class, and that's where I'll get all my assignments and know when the tests are going to be, if there's anything special that I need to do. But that's where I get my assignments from. But it gets worse, because once I complete my assignment, where do I upload it to? Back to Canvas. So I get my instructions from Canvas, I do the work, and then I give a deliverable back to Canvas, and then the teacher grades it. Where do you think the grades go? Into Canvas. That's right. And guess what weekend it happens to be for a lot of colleges and universities around the country in the United States? It's graduation weekend. And why does that matter? Because graduating seniors, if you blew a class and you fall below the graduation requirement, you don't walk. And 8,000 institutions have no idea. Some of them are still down, some of them are back up, but some of them are still down, and they have no clue about anybody's grades. And all the professors have to get back into Canvas to go reconcile all the student grades to turn them into the registrar's office, so that the registrar can basically say, this person gets to graduate, this person doesn't. Now, if you're not graduating, it's not that big of a deal, but your grades are still kind of out in the wind to twist. But it gets worse, and we're going to find out just how worse when we get into this story from the New York Times. Hannah Ziegler is writing this one. Canvas, a platform used by over 8,000 universities and K through 12 schools for course websites, assignments, and communications, shut down for several hours on Thursday. A hacking group claimed responsibility for the data breach affecting the company that owns the platform, jeopardizing the personal data of millions of students and teachers. Let's pause right there to find out what the fuck happened. There's a thing in, at least at college and university level, but I think it pretty much also does public schools. It's called FERPA. A student's personal information, like their name, their social security number, the telephone number, where they live, where they get their mail, their grades, none of that is for public consumption at all. In fact, if, like, for instance, I had to get my wife, because I had to go, when she was in grad school, I had to go do something for her. I can't remember what it was, and she was sick, and they wouldn't do it for her over the phone. So I had to go to the registrar's office, get a sheet of paper that was a release form for her to sign, so that I wouldn't be in violation, or the university wouldn't be in violation of FERPA, because I had to do something that directly impacted her private information, and I needed that. So how is it that every single college and university and K through 12 school is giving all of this information to the builders of Canvas? Do they literally have a FERPA form signed from every student at 8,000 institutions in the United States? I think not. This demonstrates that this FERPA thing is obviously bullshit, because at one point or another, the people behind Canvas, I can't remember the name of the company, they have all this information. And I know they have all this information because it's all being held hostage. Oh, the name of the company is Infrastructure. It's the company that provides Canvas to about half of all colleges and universities in North America. And they said late Thursday in an alert posted on its website that the software was available for most users. But the company added that two separate services Canvas Beta and Canvas Test remained in maintenance mode. Several prominent universities, including University of Michigan and Harvard, alerted students earlier on Thursday that Canvas was unavailable. Across the country, students have been preparing for or already taking their final exams. Instructure, not infrastructure, Instructure, that's the company, which did not immediately respond to a request for comment, said earlier that it was investigating why the software was unavailable. Shiny Hunters, the name of the hacking group that has claimed responsibility for the Instructure data breach, said that it accessed data from more than 275 million people across 9,000 schools. Let's say it again. They've accessed data, or at least they say, accessed data from more than 275 million people across 9,000 schools, according to the ransom letter shared on May the 3rd by ransomware.live. Not May the 3rd. It would have had to have been May the 7th or this morning, because it's not May the 3rd, dude. That was like 5 days ago. So, dude, these people... This is the New York Times. Are you... Whatever. An email shared with students at Barnard College in New York said the outage had appeared to be the result of a previous cyber attack on Instructure. Instructure disclosed on May the 1st that it had experienced a cybersecurity incident perpetrated by a criminal threat actor. Steve Proud, Instructure's chief information security officer, said the company had enlisted forensics experts to minimize the impact of the breach. In an update shared the next day, Mr. Proud said that the compromised information included personal identifying information like names, email addresses, student ID numbers, and Canvas messages. The company did not find evidence that passwords, birthdays, government identifiers, or financial information had been breached, he said. The breach was contained as of May the 2nd, Mr. Proud added. Quote, Canvas is fully operational, and we are not seeing any ongoing unauthorized activity, the company said on its website on Wednesday. Shiny Hunters said in a message, hold on, I skipped something. Whoa. Dude, good Lord. Shiny Hunters, which is believed to have been found or formed around 2020, claimed responsibility for the breach on Thursday in a message that appeared on students' Canvas pages and was obtained by the New York Times. The group said it had breached Instructure again after the company failed to contact it to resolve its security issue. Instead, the group claimed that Instructure ignored us and did some, quote, security patches. Shiny Hunter said in its message that it would leak an unspecified amount of data on May the 12th if it didn't hear from Instructure. In its May 3rd, okay, so now I get it, May 3rd ransom note, the group threatened to leak several billions of private messages among students and teachers. The group also encouraged affected schools, which include Duke University and the University of Maryland, to consult with cybersecurity experts and reach out to negotiate a settlement. Some students later saw Shiny Hunter's message change to an alert, saying Canvas was, quote, currently undergoing scheduled maintenance. The outage appeared to be active as of 8 p.m. Not much is known about Shiny Hunters, but the goal appears to be to obtain personal records and sell them. The hacking group has previously targeted Ticketmaster, Microsoft, AT&T, and dozens of other companies in the United States and elsewhere. The group has also recently taken aim at education companies, including Infinite Campus, a K-12 student information system, and McGraw-Hill, a prominent textbook publisher. Dude, the FERPA issue by itself is making my eyes water. This is making me laugh, kind of. I mean, I feel really bad for students, but I also feel really bad for their professors and teachers who are trying to pick up the pieces, because they're down to the wire on getting grades in, getting final exams graded, getting final papers and projects graded, and getting all that shit entered into Canvas. And all yesterday, or all yesterday evening, it was just fucking gone. It was just gone. just unavailable. I mean, they picked the absolute best time to bitch slap Instructure. And what I did not know is that Instructure had already been hacked and basically read the riot act by this shiny hunters group. I'm telling you, man, this centralized information, this shit just needs to stop. It does. Nobody can protect your shit, and it's gonna get worse. I guarantee you they leveraged some kind of Claude or LLM or something to say, hey, how can I hack this code? And who, whatever the LLM was or whatever, said, here's exactly how you do it, pal. Now they don't even have to work that hard. I'm telling you, man, greed and laziness. That's a hell of a cocktail. GameStop, $56 billion bid for eBay hits a credit wall. This is Atlas 21. GameStop has launched a $56 billion bid to acquire eBay, announcing that it has actually secured a $20 billion financing commitment from TD Securities to do so. That's the investment banking division of TD Bank. The proposal, made public this week, immediately raised doubts about its actual feasibility, with a key condition in the financing letter that could block the entire deal. According to CNBC's David Faber, citing sources who reviewed the document, the TD Securities letter includes a determining clause. The company resulting from the merger must maintain an investment-grade credit profile. This is a condition that, given the current structure of the deal, appears extremely difficult to satisfy. Moody's Ratings published an assessment on Wednesday defining the proposed acquisition as credit negative for eBay due to the substantial increase in financial leverage implied by the deal structure. The rating agency estimated that the combined company's leverage could approach 9 times the debt to EBITDA. I never can pronounce it. EBITDA ratio before accounting for any cost-saving synergies. Such a level of indebtedness would almost certainly push the resulting company below the investment-grade threshold, undermining the central condition of the TD Securities financing package. The acquisition proposal has raised immediate questions about how GameStop can finance a deal of this size. The market capitalization of the video game retailer stands at $11 billion. It's a fraction of the implied $56 billion transaction value. CEO Ryan Cohen offered limited clarification on the financing structure, stating only that the company has the option to issue additional shares to complete the deal. We'll just print some more shares. We'll print money. eBay confirmed it had received the offer in a statement published on Monday, noting that its board of directors will review it. Oh, they're actually going to review it. Well, I wonder if they're going to talk about this. Why eBay should ignore GameStop and use Bitcoin to save $1.2 billion in transaction cost. Nick Ward, writing for Bitcoin Magazine. Ryan Cohen's unsolicited $56 billion unsolicited bid to absorb eBay into GameStop has the corporate world doing a double take. Cohen's pitch sounds seductive on paper. He promises to slash $2 billion in bloated overhead and instantly rocket eBay's diluted GAAP earnings per share from $4.26 to $7.79 in the first year alone. But behind the flashy presentation lies a massive hurdle. A highly speculative cash and stock structure that requires taking on $20 billion in new debt from TD Securities and drastically diluting GameStop's own stock to buy a company 4 times its size. Analysts and investors are deeply skeptical, which is why eBay stock continues to trade well below Cohen's $125 per share offer price. eBay's board doesn't need a smaller, meme-backed retailer to step in and aggressively strip its budget to find efficiency. Instead, they can look at a real-world blueprint proving that true operational efficiency isn't found by gutting marketing. It's found by upgrading the payment layer. By taking a page out of the broader digital asset ecosystem and looking at how legacy brand Steak and Shake just revolutionized its business model, eBay can unlock a massive structural victory completely on its own terms. When the national burger chain Steak and Shake activated Bitcoin Lightning Network payments across its locations, it wasn't a marketing gimmick. The real world data completely flipped the script on corporate retail finance. 50% fee savings. Steak and Shake's leadership confirmed that processing payments over the decentralized Lightning protocol instantly cut their payment transaction cost right in half compared to legacy credit card networks. Then there's the strategic reserve angle. Instead of converting those savings back to fiat, they funneled the capital directly into a strategic Bitcoin reserve to fund employee bonuses, creating an organic, self-reinforcing financial flywheel. eBay is an e-commerce titan, facilitating massive scale across its global marketplace. In its fiscal year 2025 financial results, eBay reported steady momentum, yet it remains anchored to traditional payment rails. Because eBay runs its own internal payment infrastructure, eBay managed payments is what they call it, it is stuck swallowing massive transaction fees from legacy credit card cartels, passing those costs directly on to sellers via a hefty 13.25% take rate. If you don't know what that is, I sell an object on eBay. Let's say I sell it at exactly $100. eBay is going to take $13.25 away from me right off the top. While eBay guards its exact net processing fees, traditional credit card networks like Visa, MasterCard, and Amex, they charge large digital merchants an average global interchange and processing toll hovering between 2.5 and 3.5%. Assuming a standard 3% merchant legacy swipe fee across eBay's massive $80 billion volume, replicating Steak and Shake's proven 50% reduction in processing costs reveals a staggering annual opportunity cost currently paid to the banking cartel. So $80 billion annual GMV multiplied by 3% for the legacy swipe fee, that's $2.4 billion in friction. Now, $2.4 billion cut in half with the efficiency of the Lightning Network, that works out to $1.2 billion annually. While eBay has been letting its $2.92 billion in cash reserves sit in low-yield traditional treasury notes, generating a baseline productivity of just 12.23%, the opportunity cost of ignoring Bitcoin over the last 3 years has turned into a multi-billion-dollar boardroom mistake. If eBay's board had allocated 100% of those reserves to Bitcoin instead of flat fiat cash, that treasury would have grown by a massive 1,406%. That represents a $5.02 billion unrealized gain that eBay completely left on the table. Instead of letting leveraged buyouts dictate its future, a native crypto payment layer permanently restructures eBay's economics in favor of its 135 million active users. So here's 3 reasons why the payment play beats Cohen's takeover. 1, it protects shareholders from volatile corporate debt. 2, it empowers the lifeblood of eBay, the sellers. And 3, it dominates the collectibles market automatically. GameStop is targeting eBay because it views the platform as a massive cash-generating engine that has grown technologically stagnant. Rather than allowing a smaller company to leverage itself to the hilt for a takeover, eBay's board can render GameStop's cost-cutting thesis obsolete by using the retail industry's blueprint to fix its payment layer, cutting out the banking monopolies and returning $1.2 billion in annual savings to the marketplace. eBay can drive its own historic earnings boost, proving it doesn't need a savior to dominate the future of digital commerce. Yeah, $135 million on something as crappy as eBay is quite amazing. That the brand eBay is clearly still forefront of a lot of people's minds. I honestly don't think it's going to last, but I know you can laugh at me. It's okay because that's kind of a big thing to say. But dude, have you seen eBay lately? Have you seen the interface? They're not kidding. Dude, their infrastructure is freaking antiquated as hell. Just the front end website is painful to look at. Man, it was painful to look at 10 years ago. It ain't that much better today. I'm just saying. But yeah, this guy's got a point. Dude, you don't have to do shit. Just start taking lightning payments. See what happens. It's here's what would happen. You'd get a few people that actually start using them. Enough to where it generates data for the bean counters over at eBay to go, holy shit. If we can get more people to use Lightning Network, look at how much we can save. And then all of a sudden, eBay becomes Bitcoin's marketing engine. Just saying. Be careful. Let's go back over to Europe where I'm telling you to be careful if you do live in Europe. Europe sees a hyper concentration of crypto wrench attacks as losses approach $101 million. Cointelegraph Stephen Kate is writing. With just 34 documented crypto wrench attacks, the losses have nearly doubled those of 2025, which came in at 52.2 million. Europe accounted for 82% of those incidents, according to Certicay. Quote, our 2025 report documented a gradual tilt from Asia and North America towards Europe in these first 4 months of 2026 mark a European hyper-concentration, end quote. The frequency of wrench attacks has increased since 2025, and that was bad back then too, by the way. They involve physical force to gain access to a victim's crypto holdings and have taken the form of various home invasions, kidnappings, and other extortion attempts. Certicay said there's been 34 attacks since the start of this year alone. If the trend continues, Certicay predicts that by the end of the year, the number of incidents could well hit 130, and losses could reach several $100 million. Of the attacks, 24 crypto wrench attacks occurred in France alone. And that's just this year. France's National Prosecutor's Office for Organized Crime has reported a higher figure of 47 incidents already in 2026. Certicay said France has likely emerged as a hotspot for these kinds of criminals because of the presence of crypto executives from major crypto companies such as Ledger, Paymium, and Binance. It also pointed to numerous data leaks, such as the January breach at crypto accounting firm Waltio and tax official Galiassi, who is accused of selling crypto asset holder data to criminal networks in the culture of flexing and voluntarily doxing that remains deeply embedded inside the community. Early 2026 marks a shift to a data-driven targeting model in which prior physical surveillance becomes unnecessary once attackers have the victim's full name, home address, financial profile, and so on. The structural takeaway is clear. As the security of protocols and wallets tends to improve, the threat migrates towards the human link. As long as crypto asset holdings remain associated with identifiable financial data, physical coercion will remain the economically most rational attack path, Certicay added. Blockchain intelligence company TRM Labs reported May of last year that wrench attacks have been on the rise because of the perceived pseudonymity of crypto transactions, the public visibility of wealth, don't wear swag, and the ease of which bad actors can gather personal data online. Across recorded wrench attacks, Certicay said that the orchestrators are often located outside the target country. The criminal teams on the ground usually consist of 3 to 5 people, and they frequently pose as delivery drivers or police officers to lure victims into an ambush with the ruse such as a fictitious business meeting. Quote, most of the time, they are recruited via messaging apps such as Telegram or Snapchat for a few $1,000s. They don't know each other, and they are complete amateurs, Certicay added. So if you're in Europe, and especially if you're in freaking France, watch your back, because you thought last year was bad for wrench attacks in France. This year's already worse. And we're only halfway through the second quarter. I mean, my God, people. Stop doing shit like buying Lambos. Go buy a house out in the country. Get away from it all. Stop flying to Bitcoin conferences wearing orange socks, orange slacks, orange shirt, an orange tie, and an orange hat, and they all have Bitcoin on it. Because guess what? You don't look anywhere close to as cool as you think you look. You look like a target. That's what you look like. You look like the guy that I can see 4 blocks away and say, that guy. That's the guy that we're going to throw into the pedo van and drive away and basically get all of his money. Seriously, don't wear swag. And don't be conspicuous about your wealth. Shit, man, you got a whole life to live that you never have to do anything again. Or whatever it is. If you happen to be, I do understand this. I want to say this because I give people that buy Lambos a lot of shit. There's one person that I don't give shit to about buying a Lambo. The person that really loves Lamborghini, is a collector, knows that car inside and out, absolutely in love with the machine. That I see. But an 18-year-old kid that hits it rich in crypto and buys a Lambo, that's not that guy. That's a target. If I were to see an 18-year-old kid driving a brand new Lamborghini, I would go target. Probably crypto. And you can spot an 18-year-old kid. I'm sorry, you can. Especially when they're driving a Lamborghini. Because that car is going to focus attention on the car. And if you're cruising with the windows rolled down and you're like, 17, 18, 19 years old, they're going to look at you and go, holy shit, that's crypto. That's going to be a car to follow. And it's an easily followable car. You're an easy target. Unless you're a black belt in 3 different kinds of martial arts, I'd watch my ass if I were you. Maybe don't buy the Lambo. Maybe buy, I don't know. I don't know what to do with it. Just don't make yourself a target, and I'll be able to see you on the other side. This has been Bitcoin and I'm your host, David Bennett. I hope you enjoyed today's episode and hope to see you again real soon. Have a great day.